Hello and welcome back to the American Dream Portfolio. We are beginning to identify some of the key pieces needed to build a portfolio of hard-working assets so that one day we might enjoy our version of the American dream. Let's review the key pieces we've identified thus far. We will consider as possible investments in our portfolio US-based assets including stocks, bonds, gold, and real estate. As we learned last time, our portfolio performance should average at least 9% per year, which allows for 3% inflation and 6% real growth. This requirement must be reviewed as inflation or our individual needs change. Depending on where you live, your inflation rate may differ. In addition, your currency's value against the US dollar must be taken into account to determine your local currency rate of return. We learned that our portfolio can grow in value due to both appreciation and compounding, with appreciation having the greater impact. Our preliminary research showed that the stock performance of creative destructor companies like Amazon has been exceptional at least 10 to 20 years after going public. However, we will have to develop a method for identifying these companies going forward. It is now time to consider what investments, other than creative destructor stocks, might give us performance of 9% per year or better. Let's start with gold. You may recall from an earlier video that we pointed out gold's impressive appreciation versus gasoline since 1971. However, we don't pay our bills with gasoline, we pay with dollars. So, to determine whether gold has a place in the American Dream portfolio, we must calculate its average annual rate of return in dollars over time. Let's calculate that return from 1971 to 2026. If we do the math using a starting value of $35 per ounce and an ending value of $5,000 per ounce, we get an average annual rate of return equal to 9.4% over those 55 years. Therefore, gold squeaks by as a contender for our portfolio. However, in a future video, we will discuss a number of other parameters which must be taken into account before gold or any other investment can make the final cut. Next, let's look at bonds. In a previous video, we explained that bonds offer income from interest payments along with the possibility of appreciation. We also pointed out that bonds represent the lending of money and that typically being a lender does not offer the strength of return that being an owner does, such as ownership of stocks and real estate. But nothing in the investment world is always that tidy. Let's consider a period of history when bonds offered superior returns and apply that knowledge to today. In 1981, one of the safest investments available, US Treasury bonds, offered a rate of return which would be considered unthinkable today. In that year, investors could have purchased 30-year bonds that paid as much as 15.3% interest. To be clear, that lofty rate of interest would be paid year after year for 30 years. Talk about the power of compounding. A $1,000 bond purchased in 1981 would have compounded to $71,590 when it matured in 2011. There is no effect of appreciation in that figure because the bond itself was still only worth $1,000. Why was the interest rate on these bonds so high, and how did that rate of return compare to the stock market over the same 30-year period? The first answer is that bond yields were that high because inflation was high. US inflation peaked at 13.5% in 1980. Bonds offered by the government and by corporations had to provide high yields to make bonds attractive to investors in a high inflation economy. By contrast, US inflation averaged just 2.6% in 2025. However, in 1981, investors had been grappling with the effects of high inflation for nearly a decade. Many thought that double-digit rates of inflation might be a permanent feature of the economy. With that mindset, a 15.3% bond yield did not seem exceptional. If you subtracted the last known inflation rate from 1980, you got 15.3% minus 13.5% for an inflation-adjusted yield of just 1.8%. That's much less than the 6% real growth we are aiming for on this channel. But the persistent inflation that investors feared in 1981 didn't happen. What did happen was that inflation began to fall after 1980 and continued its erratic but downward course for the next 40 years, finally bottoming out at 0.5% in 2020. Interest rates on bonds fell right along with inflation. The result? Yields on 30-year treasuries in 2026 hover around 4.9%, which actually gives today's investors a slightly better inflation-adjusted yield than their counterparts received in 1981. But what is critical to understand here is that even as interest rates and inflation fell in the years after 1980, the government kept paying 15.3% to those bondholders. They held what might be thought of as the goose that laid the golden eggs, and that goose continued laying those golden eggs for 30 years. How did those bondholders fare compared to S&P 500 investors over the 30-year span from 1981 to 2011? The answer: the bondholders did much better. S&P 500 investors received an average annual return of around 9.5% versus 15.3% for the bondholders, and a total return of approximately 1,400% versus 7,150% for the bondholders. Even more impressive is that the government bond interest was guaranteed, whereas stock market returns were not. Okay, so how is this bit of bond market history relevant to us today? Well, it teaches us that bonds can be a superior investment, even surpassing far riskier stock market returns. But only when we purchase bonds in an environment of high inflation that is destined to fall dramatically in the years ahead. But we simply don't have those conditions today. Inflation and bond yields are near long-term averages and are, thus, unremarkable for our purpose of achieving superior growth over time. In short, bonds will not make the cut. We will demonstrate this when we compare bonds with other asset classes like stocks during our quest to build the American Dream portfolio. For now, consider that the 25-year average annual return for the total bond market index fund put out by Vanguard, a highly respected investment management company, was only 3.36%, well below our 9% target. In any case, predicting inflation rates, and therefore bond yields, may be more perilous than predicting stock prices. To be fair, bonds may be entirely appropriate for retirees and other investors looking for reliable income, but not for the American Dream portfolio, where our aim is to build wealth. In our next video, we will put real estate through a similar analysis to see if it has a possible place in our portfolio. See you then.